this is your first time joining, welcome to the Passive Investing Made Simple show. Here it is a live show and we discuss all the ins and outs and various topics related to passive investments. And today we are going to get into a very unique self-directed IRA vehicle. And I'm going to point you to some tools before we actually hand over the keys to our special guest here. But just know we do this webinar on a weekly basis. We record it live. So if you're listening on your favorite podcast player choice right now, I highly encourage you to go to the passiveinvesting.com YouTube page. And so just go to youtube.com, look up passiveinvesting.com, DOT, spell that out. Because today we've got a lot of visuals as we discuss our topic. But before we dive in, be sure to go over, hit subscribe on your favorite podcast player or YouTube page, and also register at passiveinvestingwithwhitney.com for future masterclass sessions. Check out our open deals, and if you'd like, hop on the phone with me. All right, so to kick off today's episode, I am so thankful to bring back Nick Gonzaga. He is VP of Sales at RocketDollar. And Nick, welcome. We had you on back in, I believe it was September of 2022. We had an amazing conversation with you and Brandon Walsh around self-directed IRAs. But today we're going to actually start niching down into a specific product. But just before we launch in, tell the listeners a little bit about yourself and how you got into this space.
Yeah, absolutely. So thank you very much, Whitney. It's always a pleasure to be with you on one of your presentations and your podcast. So click subscribe if you haven't already, right? So I got into this space by a friend of mine who is also the CEO of RocketDollar. His name is Henry Yoshida. He pulled me in here after I was with a company that was a benefit shop managing large 401ks for I don't know, 5-6 years. And before that, I was in another benefit shop before that. And then I was on the brokerage side. So kind of been a jack of all trades. I try to master as much as I can, but there's just certain things you can't get your hands around. So let's go ahead and jump into it. And of course, Whitney, interrupt me because this is a deep subject. And obviously there's going to be probably quite a few questions as we go through it. I try to get the best bits on this for you, so let's get it.
That's fantastic. I want to encourage people before you start, Nick. If you have a question, make sure to go over to your Q&A box and drop that in. I will be helping Nick moderate those questions where they fit in during his presentation as well. We'll hang on afterwards. So when I wrap the show, as you guys know, don't go anywhere for those of you who are joining live. We do an Ask Me Anything session afterwards, but go ahead and put those in the Q&A box so we can make sure we can track everything for you. All right, Nick, take it away.
Okay, great. So self-directed IRAs, and in this particular instance, we're going to be talking about the solo 401k part of self-directed investing. And for anybody that is at home and not looking at the presentation, you're just listening to it through the podcast. First slide right here, it's CEO looking up at Times Square, and he's looking at himself. So I think that's kind of a funny image. But basically, the text on the slide is really just saying how large the IRA market is, which a lot of people don't realize. It's 33 trillion in assets, and that's going to be both public and private investments. So the actual sector of private investments relative to public investments is quite small, right? It's considered more of a niche. So that's one thing that we've really tried to develop in terms of bringing more technology to the space, because most of what people have experienced are the old type of estate or trust companies that everything's going to be paperwork as opposed to DocuSign or lengthy processes just to get something done, or probably even services are very good, right? But the fees are high, so that's great. So moving on, what is considered an alternative asset, right? Well, it's a big umbrella, and it's essentially anything that's not publicly traded. So it could be crypto, and in this case, it's real estate, right? Passive real estate investing is probably a third of what our asset size is for all of our investors. But it could be more. It could be farmland, could be cows, agriculture, beef, almost anything. And what it can't be are things like jewels or collectibles, and we can get into that a little bit later.
So are these assets that you can actually hold in not only a self-directed IRA account or a solo 401k, you can hold them in both types of accounts?
That's correct. So really, you can do the self-directed investing in either an IRA or the solo 401k. The solo 401k, we would consider it more of an advantage for larger investments. For example, real estate, obviously being with us on the program with you. So
what is the solo 401k? Let's make sure we get that question answered.
Oh, we're getting there.
Okay.
You're jumping ahead. And I did talk a little bit about myself. So just in terms of a little bit more about my background, I'm originally from California, but I moved out to Austin maybe about 15 years ago. And since I got to Austin, I went from a variable annuity company, which is mostly insurance, and then spent, I don't know, maybe 10 years on the brokerage side, and then moved over to specific retirement planning. So all 401k, defined contribution plans, defined benefit plans. And I've been registered since 2006, which tells you how old I am. But just some quick bullet points. What we're going to go over is definitely what a solo 401k is. Who's it for, right? Because people want to know, am I eligible for it? How do I do it? So on and so forth. And the difference between the solo 401k and the self-directed IRA, because there are some pretty significant differences. I'm going to touch on the Secure Act a little bit because that recently passed, but there's quite a few, I guess, bits and pieces of the Secure Act that we won't really get into. This is more of a basics, high level sort of situation, but I'll let you know where you can find more information. The structure of the solo 401k, and then we'll talk about the required minimum distributions or minimum required distributions. Those are interchangeable. People call them both different names. And lastly, investments. So specifically, what is a solo 401k? Well, think of it as an employer-sponsored retirement plan for yourself or yourself and your wife if you happen to be married. So we get a lot of questions about, well, isn't it an IRA? It's definitely not an IRA. So an IRA is an individual retirement account. Solo 401k is employer-sponsored, which means you have higher contributions than you would in an IRA. You have employee and employer contributions. The employer contributions would be considered like a profit sharing, right? So if you think about it, at your normal W-2 workplace, if your company offers a 401k, you get a match. In a lot of cases, you get a match when you put 3% in or 5% in. You get a little bit from the company to incentivize you. Well, in this case, it's really just you're putting money away into your own 401k, depending on the compensation that you bring in from that business. You also have Roth contributions available. So as opposed to either choosing a normal IRA, which is traditional pre-tax, or between a Roth, you can do both in a solo 401k. And additionally, you can do a loan. So IRAs, you cannot do a loan. You have to just take distributions. There was some updates on the Secure Act, and we'll get into that a little bit later. But that's really one of the bigger differences between the solo 401k and an IRA. And then lastly, mega backdoor Roth. So that is a quite significant difference where you can basically change your pre-tax contributions over to Roth. And of course, you're going to have to pay taxes, but you can have a pretty sizable Roth account after the fact to do your investing so that at the end of the day, when you retire, you follow the rules of the Roth. Your account is going to be tax-free. So who's it for? As I said before, it's an employer-sponsored account, so it's for business owners. So if you have a business, maybe it's a sole proprietorship or an LLC, you can have a solo 401k as long as you have no W-2 employees, right? And there's some other aspects to know. For example, if you have another business that has employees, probably can't do it, but that's going to be more of a personal situation. Definitely give us a call over at RocketDollar and see if this is something that would fit within your personal situation. How's that so far, Whitney? Any questions?
No, I think we're good. So just to kind of, sound it back, really this vehicle is for any sort of entrepreneur, solopreneur, that
Absolutely.
proprietor. Now, I got a question for you though. I'm going to ask a question. Does being a real estate investor count?
It can count, right? Partially, it was really looking at if you can qualify the income that you generate as a real estate investor as sweat income or something to that effect, right? Passive income doesn't really count. You can't take compensation out of that and make a deferral from it. You would have to have something where you're working, right? I don't know, maybe you're a property manager or you're a real estate agent. Definitely if you're a real estate agent, that's something you could do. But if you're just collecting income, that's something that you would really need to talk to your accountant about and see if that could fit into your box.
Yeah, absolutely.
So thank you for asking that. Now, who is eligible? A little bit more going into this. We actually have an article on our website in our knowledge base that addresses most of the ins and outs of who's considered eligible. But in terms of business lines, you can have a sole proprietorship, you can have an LLC, C Corp, S Corp, and limited partnerships. What we really can't do at RocketDollar is if you had multiple owners where, let's say you had 3 partners in a limited partnership deal and you're not married, that would be difficult for us to administer. So at this time, we don't do that, but we can do husband and wife deals. So maybe in the future we'd be able to do that, but not currently. So going forward, this is probably one of the slides that's going to be, this is just a lot of information. So for people who can't see it, definitely recommend going to the passive investing website and looking at the video at some point, because there's a side-by-side, right? On the far left, we have different aspects between the solo 401k and the self-directed IRA. And in the middle, it's, middle and the right, it's those 2 types of products. So just real quick, I already mentioned the qualification for the solo 401k. Clearly, you don't really have to have a qualification to have a self-directed IRA. You just have to have retirement funds available or the ability to make a contribution to your retirement account. And the contribution limits, you would have to fall in line with those. But if you have an existing 401k somewhere, it doesn't matter how big it is, you can always transfer that into a self-directed IRA. So let's say you have 200, 500,000 in an old 401k or an IRA somewhere. You can definitely transfer that into the self-directed IRA. You can also transfer it into the solo 401k. So contribution limits. This is why I think it's huge for real estate, and not just me, but almost everybody who uses this. Is a huge advantage versus a self-directed IRA. So the max contribution for 2023 is $66,000. So that's a mix of employee contributions and employer contributions. So the EE at the end and the ER makes a difference. If you're 50, you get a catch up, and that allows you to put in $73,500. Obviously, the business would have to generate that much compensation or to put that much money in, but you get where I'm going with the size of the contributions, because if you take that amount versus what you can contribute in a regular IRA, which is $6,500 or $7,500 if you're 50, it's a massive advantage to doing an investment. It goes without saying. Custodian requirements for the solo 401k, essentially you are the trustee of the solo 401k because it's a trust. There really isn't a custodian involved there. I mean, there is, but it's a passive custodian and it's more managed for bank accounting purposes, right? The solo 401k is actually what's considered checkbook control. And we'll get into that in a little bit. For the self-directed IRA, in most cases, you will have a third-party custodian to review and approve your deals. The only way to get around not having a custodian would be if you were to have an IRA with an LLC. That would give you the checkbook control, and you'd be the administrator of or sole managing member of that LLC. I'm gonna get deep into the weeds if I start talking about that, so I'm just gonna move on.
Well, I have before you move off the slide, you mentioned that the employee and employer contributions were really important. Is there a balance between which, so you're the employer and the employee, like, is there a balance there, that you have to hit?
In terms of the money amounts that you're putting in there, or like you have to be 50% employee, 50% employer? Well, it's your business, right? It's going to be 100% yours, or you're going to share it with your wife. But in terms of making those contributions, the employee contribution will be the $22,500, right? So that's how much you can put in as an employee. The employer can put up to the maximum, whatever it is. So if you can go all the way up to 66,000 for that difference, it's like 43,500 or something like that. I'm not good at doing math off the top of my head, but it's around there, right? You would basically put all that profit sharing in to get up to the maximum. So that's really what the balance is. And a lot of people ask, well, what's the minimum? There's not a minimum. And the reason why I say that is because IRS rule is you can put it up to X amount of dollars. Not you need to put in X amount of dollars. And then if you think about it, when you are employed with a W-2, your employer doesn't come to you and say, look, if you're not going to put money in the 401k, we're going to penalize you. Well, that doesn't make sense, right? It's defined contribution, meaning I decide how much money I'm going to put into it. And then the IRS will tell me when to stop. By the way, the 22,500 maximum is an IRS maximum that goes across all 401ks. So if you have a normal W-2 paycheck, right, and your company offers a 401k, you can't put 22,000 into both 401ks. You would have to decide how much you're going to put into each to get the maximum. So wanted to clarify that because we do get that question a lot. But yes, the maximum umbrella is 22,500
for the employee.
For the employee.
Yeah, awesome. Okay.
I
think we're ready to get in the weeds, though.
Okay. And we will a little bit as the questions come in, and we might need to have a part two, right? Because like I said, it's a ton of information all happening really quickly. So moving on to the next, I guess, section of this table is rollover limitations. So you can move over just about any pre-tax account, any pre-tax retirement account, which would be a thrift sharing plan or TSP, 403B, 401A, 401K, pretty much any of those into the pre-tax side of the solo 401K. Obviously, you can do that into an IRA, but the solo 401K cannot just hold those pre-tax assets. It can also hold the Roth assets. So you can make Roth contributions, but you could not move a Roth IRA into a Roth 401K. I don't know why that's the case, but that's the IRS rule. The Roth IRA basically is, once it's a Roth IRA, it's always going to be a Roth IRA, right? So you can consider it a bit of an orphan account outside of the solo 401K. But you can always contribute or consolidate Roth IRAs to other Roth IRAs or Roth 401Ks to other Roth 401Ks. You can also move a existing Roth 401K to a Roth 401K. So that's allowed. But the Roth IRA has to stay outside. And
this is why we have experts like you helping us,
it's just a lot.
helping us do this, right? There's a lot of moving parts.
Yeah, and it looks like there's some chat. Should I jump in there?
No, let's keep going and we can backfill.
Check it out in a little bit.
Yep.
So loans, can't borrow from an IRA. Like I mentioned before, there's no loans on an IRA, just in general. Now, with the solo 401k, you can borrow a maximum of $50,000, and that goes for just about any 401k that allows loans. And it's either going to be $50,000 or 50% of the account value, the lesser of. So if you have $200,000, the most you can get is $50,000 as a loan. If you have $50,000 as account value in your 401k, the most you can get is half of that, right? So you're going to be looking at a maximum of 25,000. That's 50%. UDFI tax or UBIT tax. This is something that is also beneficial because that is not subject inside of a Roth or inside of 401k. Inside a solo 401k, there isn't UDFI tax or UBIT taxes, but inside an IRA there would be. So that's something to be mindful of whenever you make that investment using a self-directed IRA. Prohibited transactions. So there is a 15% tax imposed by the IRS if you happen to make a prohibited transaction. Obviously, I'm sure all the investors are very careful not to make prohibited transactions, so just don't do it. But if you were to do it in an IRA, then it would basically mean that your account could be disqualified and you'd have 100% distribution imposed by the IRS, and it would be taxable, and any penalties would apply, which means if you're under 59 and a half, you'd have a 10% penalty on top of whatever your ordinary income tax rate is.
So what counts as a prohibitive transaction?
So it's basically who you make the deal with, right? If you're making it with your mom or your dad, or son or daughter, or yourself, those are all prohibited transactions, right? So no close relatives. Brother, sister, I think if I remember correctly, that's fine. But it's also what you're buying. So there are specific things that the IRS says you can't buy, and there's a whole long laundry list. Well, it's not actually that long, but it's at the end of the slides. That would be collectibles or show-off assets. So if I were to say, I'm gonna go buy a wine bottle collection in my IRA, and I'm gonna drink it and show everybody my bottles of wine. Well, that's a prohibited transaction. My Babe Ruth card, I can't buy it in my IRA. That's a collectible. That's a prohibited transaction. Cars, things of that nature, art, generally speaking, and even if you were to buy gold coins and have them in your house, that's actually one of the more popular prohibited transactions, made famous by this McNulty case, and that was because it's not the fact that they bought it; it's because they bought it and they had it in their house and they could access it anytime they wanted to. So try to keep it under the arm's length rule. You don't want to be able to touch it if you're purchasing it in your IRA. It's passive and meant to be completely passive. And in terms of real estate, a lot of people like to do fixer-uppers, right? So they'll go buy a house and they'll be the landlord and they'll go and they'll fix and repair everything. Well, in an IRA, that would be considered prohibited because that's being directly involved with the asset, with your investment. Whereas you could do the fix it up and rent it out or sell it, but you would have to have somebody else do all the work, and you would have to pay them out of the IRA or the retirement account, so 401k in this case, to do all of that. You wouldn't be able to use additional funds from a bank account because that would be prohibited. You just commingle the assets. So there's a red flag for that. So moving on. Trustee plan administrator, as I mentioned, the solo 401k is a trust. So you'd be the trustee. And then in a normal, typical self-directed IRA, the client is an individual account holder. right? You can't have an IRA with a joint account because it's an individual retirement account. You can't have joint registration under that type of account. Whereas with the solo 401k, you have a husband and wife, potentially, right? So you can have basically accounts for you and accounts for your wife all under one account.
So I have a question on that.
Yeah.
Does it have to be a husband and wife? Can it be the spousal equivalents? Like, I can't imagine in today's age that it's only for a man and a woman. I'm just curious.
Oh, right to your local congressperson to get that updated. But yes, it is. It is the traditional husband-wife situation. It isn't. As far as I know, I haven't seen a situation where the spousal equivalent was allowed, right? And we've had situations like that come across our plates. Yeah, it's frustrating for some, but I think it's just a matter of trying to get the IRS to update it to 2023.
And I'll be sure to get one for my husband. Just kidding.
Definitely. Huge advantage. So did you hear? Did I mention that? But anyway. So for us, the Solar 401k is the passive custodian SDIRA National Bank, right? So basically, whenever there's a transfer or a transaction to purchase an investment, it's usually going to, the source account is going to be the bank account at SDIRA National Bank, whether it's a traditional or Roth, and you're really just going to either send money or write a check to the investment that you're making. We do have some members at RocketDollar that like this particular type of account just because they can show up to an auction and purchase property on the court steps by writing a check, like you would with a normal bank account, but it's a retirement account. And the custodian for the normal self-directed IRA would be American Estate and Trust if you were to purchase one of those direct custody accounts from RocketDollar. Of course, there's other custodians out there that would operate much in the same way that American Estate and Trust does. Bank account option, same thing. And checkbook control, it's either only going to be available with the Solo 401k or the IRA LLC. Normal setups like the direct custody setup, they don't have bank control. That's a review and approval process by the custodian. So they look at the documents and say, yes, okay, that's fine. Or we're not going to allow you to do that until you give us more paperwork, or we're just not going to do it at all. One additional tax reporting item that the Solo 401k has that the self-directed IRA doesn't have is the 5,500, but that only comes into play when the account is greater than $250,000. So for us, we'll have members open an account on the silver side because it takes a while to build up those assets or that account value, depending on what you're invested in. But once it gets closer to the 250,000 mark, then they'll upgrade to gold because we'll go ahead and file the 5,500 for them. Clients are able to do it on their own if they don't want to upgrade to gold. It's just a matter of finding a CPA that would do it and paying them to do it. It's a little bit more of a specialty where most CPAs that are filing 5,500s are working for larger plans and not really working with small business entrepreneurs. Max number of accounts for the Solo 401k. So I mentioned this before. I didn't mention the after-tax buckets just because that's a lot to get into. It can be confusing because Roth is after-tax or post-tax, and then there's an after-tax bucket on top of that. That's just more description, and we can either talk about it on the next one, or if anybody has specific questions, I can get into that with them. But the max number of accounts would be 2 pre-tax accounts, 2 Roth accounts, and 2 after-tax accounts. I mean, husband and wife, right? So that's 6 accounts total under one product type. Most people will only do 4, right? Husband and wife, traditional and Roth. Self-directed IRAs, you only have 1. You're either gonna, there's no after-tax there. It's either gonna be a Roth or it's gonna be a traditional pre-tax account.
So can you have more than one solo 401k?
You can, but it really wouldn't make sense, right? Because the maximum is still going to be the same. You're still going to have both Roth IRA and traditional IRA buckets. So just because you have another solo 401k doesn't mean you'd be able to put more money than you would in your existing solo 401k. You're still going to have those IRS limits. You can have solo 401k and IRAs if you want, or if you need to. Like, for example, if you have an existing Roth IRA, you can't move it into the solo 401k, so that has to live outside. But you can make Roth contributions. Doesn't matter how much money you make, right? So that's another thing. Anybody can do a Roth contribution. There's no phase outs in terms of how much income you're making.
And that's under the Roth solo 401k.
Roth solo 401k. Right. Roth IRA, if you make too much money, yes, you can't do a Roth contribution. You have to do some weird backdoor arrangement. But
and is there any limit in rolling funds from like an IRA into a self-directed IRA? Like, and it's actually, and correct me if I'm wrong, it wouldn't be an IRA, it'd be like an old 401k into.
Yeah, you could. So there isn't a limit on direct rollovers, right? So direct rollover is basically doing a distribution from one 401k or IRA into another retirement account, plan, or solo 401k in this case. There is a limit to how many indirect rollovers. So that would basically be taking the money, putting it into a bank account that's taxable, and then within 60 days, pulling it back out, putting it into a retirement account. We do what we can to encourage people not to do that, just because anything can happen, right? If at the end of the 60 days, you can't make that return contribution and it can only be in cash, then you're looking at a taxable event, right? So whatever you took out and whatever you didn't put back in is going to get hit with taxes and whatever penalties, if there's any applicable penalties. So now, fun part, fees. Everybody loves talking about fees. So our fees are transparent, straight up front. We don't deduct anything from the account. It's generally going to be all coming from either a credit or a debit card. We do have an initial onboarding fee for the silver membership, which is $360, and then it's only $15 a month after that. Yes, you will pay the first month's $15 when you sign up. The gold membership is $600 up front, and then $30 monthly. Same thing. First months get paid whenever you sign up. So it's right from when you sign up until you close out the account. And terminating the account is easy. Once you don't have any assets or cash in one of the RocketDollar accounts, you can just say, hey, I want to go ahead and close my account out. And then you just stop paying us. There's no termination fee or anything like that. That was a ton of information. How we do it.
And for those of you who are here live, be sure to stay on for the Ask Me Anything portion after our presentation, and we will make sure to get to everybody's questions that we didn't get to in the recorded part. Nick, I want to pass it back to you because you have a couple more sections to go through.
Thank you. And again, if there's anything in here that you're like, hang on, I want to revisit that, just let me know, obviously. So, Secure Act 2.0. Now, there's a lot packed into these changes. So we tried to do what we can to trim it down to snippets and still maintain the integrity of what the change is. In some cases, it just wasn't possible. There was too many, I guess, additional if this, then that kind of situations. So required minimum distributions currently, or even up to, the beginning of this year, you had to be 72, start taking minimum distributions. And if you don't know what that is, basically when you get to a certain age, which would have been 72, the IRS says, okay, you have to take out this much amount in your pre-tax account, and if you have a Roth in your 401k, then it would apply to that too, the minimum amount, so that it could get taxable or taxed. The new law, they increased it. So instead of 72, it's 73. If you turn 72 after 12/31/22, or if you turn 73 before January 1st, 2033. And then there's another raise after that. So if you turn 74 after December 31st, 2032, then it's going to be 75 when you start taking out those withdrawals from the pre-tax count. There's also an indexing IRA catch-up. So right now it's $1,000 if you're at least 50. So for the IRAs, if you're at least 50, then instead of doing the 6,500, you could do 7,500. The new law is actually indexing it to inflation in $100 increments. Now, there wasn't a whole lot to go on when I was reading about this, so I don't really know how that's going to be applied at this point. Again, it's really new. Didn't have a whole lot of time to dig real deep into it. They are increasing the defined contribution plans for the catch-up limits. So right now it's 6,500. The new law has increased it for people that are 60 to 63, which is the greater of $10,000 or 150% of the catch-up amount that's indexed for inflation for 2024. I don't know what that means. Right? I think I have to actually see what it looks like before I know what the limit is. So again, a little bit of some moving parts here in this Secure Act 2.0, but by the time we start putting it into practice, we'll know what they're talking about a little bit more. IRA emergency withdrawals, so those really don't exist right now, right? So if you take a withdrawal and you're under 59.5, there's going to be a 10% penalty imposed by the IRS, and that's on top of ordinary income tax, whatever your tax bracket is. Now, the new law would allow you to take one penalty-free withdrawal. So you still might pay taxes, but you're not going to pay the penalty up to $1,000 a year. And that can be repaid within 3 years. There's additional rules there, something to the effect of you can only take one in a 3-year period if you're paying it back. I couldn't fit all that into that little box, so sorry, guys. But there's going to be more information on that too. Solo 401k contributions, the employer contributions. Sorry, I had to take a drink of water. I apologize. I don't know what I was trying to put in there. It looks like I didn't complete it, but it has something to do with employer contributions. Probably they raised it. Oh, I know what it is. Sorry, I just had a gap. So solo K contributions have been changed for the deadline to make them. So the new law, if you try to make a the existing law, if you make the contribution after the end of the year, generally speaking, it's only employer contributions, unless you have some tax reporting that you do with your accountant and you're able to file or make contributions up to your filing deadline. So there's, again, that does have moving parts. I can't really get it deep into the weeds here. But the new law, if you have a sole proprietorship and you're setting up a new plan, you can make contributions as an employee and employer up to your tax filing deadline. So that is actually extended for people who are just setting up a new solo 401k as a sole proprietor. So that's actually pretty nice for people who are just setting up their account. A lot of people just can't make that deadline when they're opening it, just because people wait till the last minute.
So essentially, you could open one and make contributions for last year. Is that what I understand?
Exactly. So say, for example, you open the account and you open it now. So you'd be able to make contributions if you're a sole proprietor for a previous year, which will count for 2022 up until April of 2023, which is more along the lines of what you do with an IRA, right? You can make previous year and current year contributions for IRAs. You really can't do that with 401k unless you have help from an accountant to make those adjustments on your tax returns. Prohibited transactions. This it was never really clear. I mean, with how that would affect IRAs when people, if somebody were making something a little risky, right? They're making an investment in something that might potentially could be prohibited. There wasn't any real clarification if it was going to be for each individual IRA or across your IRAs. In most cases, people had just assumed that it would just be for that one particular IRA. Well, the new law actually clarifies that each individual IRA is its own contract. So if a prohibited transaction happens in that IRA, then the other IRAs wouldn't be affected. So that helps us a lot. And if you want to know infinitely more about the Secure Act 2.0, you can Google search. The keywords would be Secure Act 2.0 Groom Law. So a lot of this information, we don't write it ourselves. We get it from resources. And Groom Law is a company that did a really good job summarizing a lot of this information. So I feel that it's only fair to share this information with everybody that decided to join us today. If there's anything in here that they'd like clarification on.
And I want to make sure we leave plenty of time for the Q&A section. So if we can, let's, kind of summate the rest of the Secure Act and then dive in with, like, if somebody's here on the webinar today and wants to open up a solo 401k, what do they need to do?
Okay. So this is the last slide for the Secure Act. SEP simple Roth IRAs, currently you can't do them under the new law. Yes, you can. Defined contribution catch-up. The employee can choose their catch-up contributions to be pre-tax or Roth. The new law says, well, if you make more than 150,000, you can only do Roth catch-up contributions. Doesn't apply to SEP or simples. 529 rollover to Roth. Previously not allowed. Now it is under Secure Act 2.0. So you can do 529, move it into a Roth if you want to do that for your kids, or if your kid wants to do that. Retirement lost and found. We don't have that right now, but evidently the Department of Labor has been tasked with creating a lost and found database for any old 401ks or retirement plans that are essentially orphans out there floating around in space. There's quite a bit more. We can do a part 2, but if you are a small business entrepreneur and you want to set up a solo 401k, or if you have an existing solo 401k and you want to move it, convert it over to RocketDollar, you basically just go to the RocketDollar website, click Get Started or Invest Now up in it's a purple box in the top right corner of the screen from the homepage. Select solo 401k and go through adding your personal information in there. So these plans do take at least 2 weeks to set up if you're a gold member. Could be 3 to 4 weeks if you're a silver member. But that would also include having the funds get transferred over and fund into your account. And essentially you'd be ready to go at the end of those 2 weeks or 3 to 4 weeks to make that first investment. There's a lot of legwork that's done up front to get these accounts set up. Do you want to keep going, or do you want to start Q&A now? Maybe we can pick this back up on a part 2.
I will go ahead and wrap for those of you who are listening on your favorite podcast player of choice. Thank you so much for joining us today. Nick, for those people who are listening in it after post-webinar, live webinar, who are listening on YouTube, listening on their favorite podcast player of choice, how can they best connect with you and figure out if this is the right option for them?
Thanks for asking. And the best way to get a hold of us is if you go to the homepage, there's our phone number to the sales team, or the email that we have, info@rocketdollar.com. You can shoot us an email with any questions that you might have. What we do is we'll respond to your question, but we'll also put in an article that we've written from our knowledge base. So we have at least 200 articles, maybe even more. They've all been written by somebody at RocketDollar based on the questions that we get from clients or prospects. So that's the easiest way to get a hold of us. And we're on the phone. I'm on the phone. So if you give me a call, if you give us a call, I'll probably answer it. And we can go through your questions. So specific situations, I'm an employer, I have this account, here's what I want to do. We can't obviously give any tax, investment, or legal advice, but we'll do the best that we can to get you the information that you're looking for. Thanks, Whitney.
Yeah, absolutely. Well, again, and for those of you who are here joining us live, don't go anywhere. If you're listening to us after the fact, I hope you've enjoyed today's presentation. And just to kind of connect the dots for you, if you are a solopreneur or an entrepreneur, you have your own business, this is a solution that might be an opportunity for you to consolidate some of your money into an account that allows you not only to build up retirement funds quicker, and have more control on where you invest them and operate with a little bit more speed. Nick, as always, thank you so much for joining us today. Don't go anywhere. And everybody here, have an amazing day. And thank you for investing your #1 resource, which is your time, here with us and in yourself.